Brad Williams, Frugal Finance, buying and selling bonds. How do you go about doing that? Bonds can be bought when they're issued on the primary market and held until maturity, or they can be traded through a broker-dealer on the secondary market. A bond's face or par value and interest remain fixed for the life of the bond. But if you buy or sell a bond after it's been issued, its price is subject to market forces and often fluctuates above or below par. Because there is such a variety in bond rates and terms, some bonds trade more frequently and liquid than others. Like stocks, most bonds can be purchased on margin. The way you buy and sell bonds on the primary market often depends on the type of bond you select. Treasury bonds can be bought in denominations of $100 through an account at a brokerage firm or commercial bank, or directly from the U.S. government through auctions. Savings bonds, EE and I bonds, can be purchased electronically for as little as $25 through Treasury Direct. You can also purchase paper I bonds, but only if you do so using your income tax refund. Corporate and municipal bonds can be purchased like stocks through full service, discount, or online brokerage firms, as well as through investment and commercial banks. Once new issued bonds have been priced and sold, they begin trading on the secondary market, where buying and selling is handled by a brokerage firm or investment professional. For Treasury bonds, if you bought directly from the U.S. government at auction and want to sell before maturity, you'll need to transfer your Treasury bond to a brokerage firm or commercial bank and ask them to sell it for you. Bonds can be bought and sold through an investment professional, your brokerage firm's website or app, or the fund directly. Keep in mind that if you work with an investment professional, the choice of bond funds is limited to those the brokerage firm allows its professionals to sell. Selling before the maturity date. If you sell a bond before it matures, you may not receive the full principal amount of the bond and won't receive any remaining interest payments. The price you receive will depend on where the bond is currently trading on the secondary market. This will be more or less than the amount of principal and the remaining interest the issuer would be required to pay you if you held the bond to maturity. The price of a bond can be above or below its par value for many reasons, including whether the credit rating for the issuer or the bond itself has changed, a change in supply and demand, and a host of other factors, but it's often driven by changing interest rates. If you sell a bond before it matures or buy a bond in the secondary market, you most likely will catch the bond between coupon payment dates. If you're selling, you're entitled to the price of the bond plus accrued interest, the interest that adds up each day between coupon payments up until the sell date. The buyer compensates you for this portion of the coupon interest, which is generally handled by adding the amount to the contract price of the bond. Use this accrued interest calculator to figure out a bond's accrued interest. Bond pricing. Bond quotes are typically expressed as a percentage of their par value, with the percentage converted to a point scale. A $1,000 bond trading at par is said to be trading at 100. A bond quoted at 105 is trading at a premium at 105% of par, or 1,050. A bond quoted at 95 is trading at a discount at 95% of par, or 950. Remember, bond prices and interest rates move in opposite directions. If you own a bond that pays a coupon of 8%, but new issuance are only paying 5%, so interest rates fell, the secondary price of your 8% bond will rise because people will be willing to pay a premium for that higher coupon payment. Bonds and interest rates. When it comes to how interest rates affect bonds, there are three cardinal rules. When interest rates rise, bond prices generally fall. When interest rates fall, bond prices generally rise. Every bond carries interest rate risk. One of the key determinants of a bond's coupon rate, the interest you receive, is the Fed funds rate, which is the prevailing interest rate that banks with excess reserves at a Federal Reserve District Bank charge other banks that need overnight loans. The Federal Reserve sets a target for the Fed funds rate and maintains that target interest rate by buying and selling U.S. Treasury securities. Another rate that heavily influences a bond's coupon is the Fed's discount rate, which is the rate at which member banks may borrow short-term funds from a Federal Reserve bank. The Fed directly controls this rate. Say the Fed raises the discount rate by 0.5%. The next time the U.S. Treasury bonds holds an auction for new Treasury bonds, it will quite likely price its securities to reflect a higher interest rate. Those new bonds pay more interest. What happens to the Treasury bond you bought a couple of months ago at the lower interest rate? they're not as attractive. If you want to sell them, you'll need to discount their prices to a level that equals the coupon of all the new bonds just issued at the higher rate. It works the other way too. Say you bought a $1,000 bond with a 6% coupon a few years ago and decided to sell it 3 years later to pay for a trip to visit your ailing grandfather, except now interest rates are at 4%. This bond is now quite attractive compared to other bonds out there, and you'll be able to sell it at a premium. Brokerage firms' role in compensation? In the majority of bond transactions, a brokerage firm acts as a principal, selling you a bond it already owns. When a brokerage firm sells you a bond in a particular capacity, it may increase or mark up the price you pay over the price the firm paid to acquire the bond. Similarly, if you sell a bond, the firm may offer you a price that includes a markdown from the price at which it believes it can sell the bond. A markup or markdown is the brokerage firm's compensation. If the firm acts as an agent, meaning it acts on your behalf to buy or sell a bond, you may be charged a commission, which will appear on your trading confirmation. Bonds and taxes? The tax rule that applies to bonds are complicated. Whether or not you will need to pay taxes on a bond's interest income, coupons, or a bond fund's dividends often depends on the entity that issued the bond. You might want to check with your tax advisor tax consequences before you invest. For additional information on the tax treatment of investment income, see IRS Publication 550 and the IRS's Net Investment Income Tax FAQs. If you have any questions relating to buying and selling bonds, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.